Most traders don't lose because their strategy is bad. They lose because they enter too early, at the exact moment liquidity is being collected. In this video, I'll show you how to wait for one extra confirmation that can completely change the quality of your entries, using supply and demand, a liquidity sweep, and a simple candle trigger. Before we begin, here's a quick disclaimer. This content is for educational purposes only and reflects personal opinions. It is not financial advice. Trading involves risk, and you should always consult a licensed financial professional before making any investment decisions. With that being said, here's what you will learn in this video. How to map supply and demand zones the way a scalper needs them. The 4 patterns that form the backbone of this approach. The 4-point checklist that filters nice-looking zones from tradable zones. How to wait for the liquidity sweep so you're not the one getting stopped out right before the move. The simplest confirmation signals to use after the sweep. A step-by-step execution plan you can repeat on Forex, indices, crypto, or futures. Before we begin, if you enjoy this type of content and want to see more, please like this video, subscribe to the channel, and turn on the notification bell so you don't miss future uploads. With that being said, let's get started. Alright, let's dive into the foundation of this strategy, supply and demand zones. These are the key areas where institutions, or what we call smart money, place their orders. Understanding these zones is crucial because they show us exactly where the big players are entering and exiting the market, and that's the kind of information we want to capitalize on. A supply zone is a price area where selling pressure is strong enough to stop the price from going higher. This zone often appears after a rally or uptrend when big players like institutions or banks start selling to take profits. As a result, the market reacts by dropping from this level. A demand zone is a price area where buying pressure is strong enough to stop the price from going lower. This zone often forms after a decline, where big players step in to buy, pushing the price back up. To spot where the market is likely to move, you need to recognize that supply and demand zones show up in 4 distinct patterns. Mastering these patterns will help you identify when and where the market is most likely to reverse or continue its trend. Let me introduce you to the drop-base rally, a powerful bullish reversal pattern. This isn't just any price action, it's the footprint of smart money at work. Here's how it goes. The price drops. This is the market pulling back, often shaking out weak hands. Then comes the base, a consolidation phase where buyers start quietly accumulating. But here's where the magic happens. This isn't just consolidation, it's manipulation. The smart money is gathering strength. Finally, we see the explosive rally. Buyers take control, driving the market upward. What's happening here is more than just a price move, it's a strategic play by institutions. They push the market down, accumulate positions at the base, manipulate the market to get the best price, and then let the rally fly. Now, let's look at a real chart example of this drop-base rally pattern. As you can see, the drop isn't just a random move, it's a deliberate smart money play, a liquidity grab designed to trigger stop losses and shake out retail traders. Next comes the base. This is where accumulation happens. Smart money quietly builds their buy positions here, preparing for the next big move while everyone else is uncertain. During the base, there's often manipulation. They create false signals to trick retail traders into thinking the market might drop further. Finally, we get the rally, a strong upward move as smart money takes control, pushing the price higher. This drop-base rally pattern marks a key demand zone, a spot where smart money left their footprints. As a scalper, you know this zone is a reference point for institutions. When the market revisits this area, there's a strong chance it will explode higher again. Because when smart money bought here, they didn't do it all at once, they bought gradually to avoid spiking the market. When the price comes back to this zone, institutions have limit orders waiting, and retail traders who try to jump in too soon often place their stop losses nearby. The result? The market sweeps liquidity, triggering those stops and then surging upward, exactly the move we want as scalpers. Now let's switch to the rally base drop, a classic bearish reversal pattern. The market rallies upward, hits a base where institutions start selling, and then drops sharply. This base forms the supply zone, where smart money leaves its footprints, creating a high probability area for future price action. When the price revisits this zone, institutions already have their limit orders waiting, and the market often sweeps liquidity from retail traders who have placed their stop losses just above the zone. This triggers a strong drop, exactly the move we want to catch as scalpers. Now, looking at this real chart, we see the rally-based drop pattern in action. First, there's a rally, a move driven by smart money as the price pushes higher. Then, the the market hits a base. This is where institutional traders begin offloading their positions, creating a supply zone. What happens next? The price makes a sharp drop, but this is where we need to stay patient. As scalpers, we wait for the market to retest the supply zone. This is the moment smart money might come back in. When the market revisits this zone, it's our chance to enter quickly and catch the next downward move. The key here is the retest. That's where we can get in without needing to chase the move. Once we're in, we look to exit fast, locking in profits before the market fully reacts. Now, let me show you something truly powerful. In this same chart example, we can see the market creating both a drop-based rally and a rally-based drop, a perfect illustration of how smart money operates. First, the market forms a drop-based rally, creating a demand zone. As the market approaches this zone, it sweeps liquidity and then moves upwards. This is a classic smart money move, taking out retail traders before driving the price in their intended direction. Later in the same chart, we see the market form a rally-based drop, establishing a supply zone. Once again, as the market returns to this zone, it sweeps liquidity and moves downwards, trapping retail traders in the process. What's happening here is no accident. These are trading machines, algorithms programmed to trade this way. By mastering these patterns, you're essentially decoding how the machines and algorithms trade. The beauty of this strategy is that it's robotic. These moves repeat frequently in the market, offering endless opportunities. So by identifying where smart money enters and exits, you can start taking the same trades and trade like a pro. Now, don't take any action just yet. This is just the basics. I'm laying the foundation, but we're going to go much deeper into this strategy. So keep watching, because by the end, you'll know exactly how to use this setup to its full potential and make the most out of these market moves. Next, let's look at the rally-based rally pattern. This one's all about bullish continuation. Here's what we're looking for. The price makes a strong rally, and instead of reversing, it forms a base. But this time, the base isn't signaling a drop, it's just a pause before the price continues its upward move. This base shows us where institutions are building up more buying power, and when the price pushes up again, it confirms that buyers are still in control. Looking at this real chart, we can see the rally-based rally pattern play out perfectly. First, there's a strong rally. Smart money and institutions are driving the price upward. This is a clear sign that they're stepping in and taking control of the market. But here's where psychology gets interesting. The market pauses, forming a base. For retail traders, this might look like indecision or a sign that momentum is fading. But for those in the know, it's a completely different story. This base is where institutions are quietly adding to their positions, preparing for the next leg up. They're accumulating more buying power while keeping the market calm. What we're looking for here is the next move, the second rally. When the price breaks out of the base, that's our confirmation that buyers, led by smart money, are still in control. As scalpers, our focus is to catch the move when the price returns to retest the base. That's where we can enter quickly, ride the continuation, and exit just as fast with profits in hand. Finally, let's break down the drop-based drop. First, we have a clear drop. The market is in a downtrend, and sellers are dominating. The price then pauses briefly, forming a base. This isn't a sign of a reversal, but rather, it's a moment where institutions are setting up for the next wave of selling. What comes next? Another sharp drop, as the selling momentum resumes. This base forms a supply zone, a key level where institutions have offloaded their positions and are ready for more downside pressure. Now, let's move to a real chart to see the drop-based drop in action. First, we see a strong downward move, followed by a pause where a base forms. This base is where institutions are quietly gathering their sell orders. After this accumulation phase, the market drops sharply again. Smart money doesn't sell everything at once. If they did, they'd disrupt the market. Instead, they sell gradually, allowing the market to accumulate liquidity. Then, they manipulate retail traders and sell again, forming this drop-based drop pattern, a clear smart money footprint. As scalpers, our goal is to spot this zone and wait for the market to come back and retest it. Once that happens, we can look to enter. But it's not as simple as it looks. There are more details and conditions you need to be aware of, and I'll explain those next in this video. Now that you know how to spot supply and demand zones, let's take it a step further and make sure you're only focusing on the best zones for your scalping strategy. Not all zones are worth trading. Some are strong, others are weak and won't deliver the quick profits we're aiming for. The key to scalping is speed, so you need to know how to filter out the weak zones and focus only on the ones that can deliver fast, reliable moves. Based on my experience, there are 4 critical factors. The first factor is the candle size of the move. Big institutions leave footprints, and one of the most obvious signs is the size of the candles. If the candles are large and consistent in color, it's a strong signal that smart money is behind the move. On the other hand, if the candles are small, mixed, and full of wicks, the move likely lacks institutional power, so it's best to skip it. The second factor is the freshness of the zone. Only focus on zones that have never been tested. The first test is your entry. When trading the 5-minute time frames, you'll come across a lot of zones, and this filter is essential. Fresh zones tend to respond positively, leading to profitable trades. Once a zone has been hit even once, it loses strength, so it's best to avoid zones that have already been tested. The third factor is the breakout of structure. When identifying strong supply or demand zones, look for moves that break through key levels of market structure, such as previous highs or lows. A breakout of structure signals that smart money is behind the move, as they push the market beyond these levels to trap retail traders and trigger their stop losses. When the market breaks through structure, it's not just a random move, it's a clear sign that institutions are driving the price action, creating a strong zone. These breakouts indicate a shift in market dynamics, and they provide you with high probability trading opportunities. The fourth and final factor is the risk-to-reward ratio. This is critical. Don't trade a zone unless it offers at least a 3-to-1 risk-to-reward ratio. If the potential profit isn't at least 3 times your risk, it's best to skip the trade, even if the zone looks strong. Without a solid risk-to-reward ratio, you'll lose in the long run. Now that we have covered the key factors for identifying a high-probability supply or demand zone, such as candle size, freshness of the zone, breakout of structure, and a 3-to-1 reward-to-risk ratio, keep these in mind as we move forward. These factors are the foundation of finding the best trading opportunities, so let's apply them to some real chart examples. Let's dive into this real chart example. As you can see, we have a demand zone forming here. Now let's break it down and see if this zone meets the criteria of a high-quality zone or if it's one we should avoid. First, take a look at the candles leading into the demand zone. Notice how we have large, strong candles moving in the same direction. This is a clear sign that institutional money is behind this move. Big candles, especially those with little or no wicks, indicate a significant volume of buying power, exactly what we want to see in a high-probability zone. Now, let's check the freshness of this zone. You'll notice that this demand zone has never been tested before. It's a fresh zone, which means it's more likely to produce a strong reaction when the price comes back to it. As we discussed earlier, the first time a zone is tested is often the most powerful entry, and that's what we're aiming for. Next, look at how this move has broken the previous market structure. See how it broke above a key resistance level, creating new highs. This breakout signals that smart money was involved in pushing the market higher, trapping retail traders along the way. This is a classic sign of a powerful demand zone formed by institutional buying. Finally, let's calculate the risk-to-reward ratio. From this entry point, we can see that the zone offers a potential 3-to-1 risk-to-reward setup, which is exactly what we need. This ensures that even if the trade doesn't win every time, we're still profitable in the long run by sticking to high-probability zones with a strong reward-to-risk ratio. Based on the 4 factors we just analyzed, this zone clearly qualifies as a high-probability demand zone. It meets all the key criteria: strong candles, freshness of the zone, a breakout of structure, and the right risk-to-reward ratio. So yes, this zone should be taken seriously. But before you rush off to trade it, remember, we're still in the process of filtering. This is just the foundation. There are more critical conditions to be respected before you take action. So don't stop watching now. There's much more to come that will help ensure you only trade the best zones with confidence. Now let's look at another chart example, this time, a supply zone. We'll quickly run through the 4 factors to see if it qualifies as a high probability zone. First, check the candle size. Notice how we have large, consistent bearish candles leading into the zone. This shows strong selling pressure, likely driven by institutional money. Next, the zone is untested, it's fresh. No previous touches, which means the first time the price revisits this level, we're likely to see a strong reaction. Look at how the move breaks below a key support level. This is a breakout of structure, a clear sign that smart money is in control, pushing the market lower and trapping retail traders. Finally, the risk-to-reward ratio offers at least a 3-to-1, meaning we have a good chance of profiting, even if the win rate is lower. Based on these 4 factors, as you can see, this supply zone meets all the criteria of a quality supply zone and should definitely be taken into consideration. Now, let's look at this chart where we've spotted a demand zone. At first glance, it seems promising, but as we apply the 4 key factors, you'll see why this zone should be ignored. First, the candles making up the move that forms this zone are large and consistent. This is a strong sign that institutional money might be involved, so we're off to a good start. The zone is fresh, meaning it hasn't been tested before. That's another positive, and it suggests that we may see a strong reaction when the price revisits the area. Next, the move does break through the previous structure, breaking above a resistance level, which is what we want to see. However, this is where the problem lies. When we calculate the risk-to-reward ratio, it doesn't meet our 3-to-1 minimum. The potential reward is simply not worth the risk, which makes this trade too risky to take. Even though this demand zone meets 3 out of the 4 criteria, it lacks the crucial risk-to-reward ratio. And in our scalping trading strategy, if just one criterion is missing, the zone should be ignored. Remember, we're only interested in high-probability setups that offer us the best chance for success. But don't worry, in the 5-minute time frame, you'll always find plenty of zones to choose from. The key is to be patient and disciplined, waiting for the right setup. Alright, now that you know how to identify supply and demand patterns and how to filter out the high-quality zones, you're already ahead of the game. Let's move to the next step. Waiting for what I call the second confirmation, the liquidity sweep. Let me break it down for you. A liquidity sweep is a tactic used by market makers to trap retail traders, trigger their stop losses, and fill their limit orders. Here's how it works. The market moves up and breaks a resistance level, then pulls back to retest that same level, which has now turned into support. This level becomes a liquidity area, holding lots of stop losses and pending limit orders. What do market makers do? They push the market to sweep that liquidity by breaking just below the support level. This triggers all the stop losses, fills the limit orders, and then, here's the key part, reverses the market back up. It's a classic move by smart money to clear out the retail traders and get the best entry. And this is exactly what happens when they approach supply or demand zones as well. Now, let's take this back to the demand zone we've identified on our chart. We already know it's a high probability zone, but before we jump in, we need to wait for that liquidity sweep to happen. Because this is exactly how smart money operates, and we want to be on their side, not the side of the retail traders who get trapped. What do we need to see? We should look for a breakout of the demand zone, where the price dips below the zone to trigger stop losses, and then a close back above the demand zone. This is the liquidity sweep. It tells us that smart money has absorbed the liquidity and is now ready to push the price higher. When you see a liquidity sweep at a demand zone, that's your signal that institutions are paying attention to this level. It shows that smart money is getting ready to take action, and we need to be prepared. Now that we've covered the 2 key components of our strategy, identifying high-quality supply and demand zones and waiting for a liquidity sweep, it's time to move to the next crucial step: price action confirmation. When a liquidity sweep happens, it leaves a footprint in the form of specific candlestick patterns. For this strategy, we focus on 2 simple price action confirmation signals: the pin bar and the tailed bar. Tailed bars can also appear as dojis, offering the same confirmation. Let's start with the pin bar, a powerful signal that gives us insight into what smart money is doing. A pin bar is a candlestick pattern with a small body and a long wick. The body shows where the price opened and closed during the time frame, while the tail represents the range the price moved during that period. When a pin bar forms, it signals that the market attempted to move in one direction but was quickly rejected by strong forces in the opposite direction. This rejection tells us that the initial move was likely false, and the real move is about to go in the opposite direction. When a bullish pin bar forms at a demand zone, it's an important signal. Here's what happens. Smart money pushes the price down into the demand zone to sweep liquidity, triggering stop losses or filling limit orders from retail traders. But the buyers step in quickly, rejecting the lower prices, which forms the long tail of the pin bar. This tells us that the market has tested the demand zone, absorbed the selling pressure, and now buyers are taking control. The small body of the pin bar shows that the price is likely to move upward from this point. This is our confirmation that smart money is interested in this zone, making it a great opportunity to enter a buy trade. Let's take a look at the bearish version of a pin bar. When a bearish pin bar forms at a supply zone, the psychology is reversed. Smart money pushes the price up into the supply zone, again triggering liquidity sweeps by breaking through stop losses or filling limit orders. However, this time the sellers step in and reject the higher prices. The long wick shows that the price was rejected from the supply zone, indicating a likely downward reversal. This tells us that sellers are now in control, making it a strong signal to enter a sell trade. Now, let's move to the second liquidity sweep signal, the tailed bar. A tailed bar is a candlestick pattern where the body is small, but the key feature is the long tail or wick extending from one side of the candle. This tail represents the area where price was rejected, indicating that smart money stepped in to reverse the move after the liquidity sweep. The long tail shows where the market tested liquidity but quickly reversed, leaving that tail behind. We can also consider a doji as a type of tailed bar, using it as a confirmation signal in the same way. Let's start with a tailed bar at a demand zone. When the market moves down into a demand zone, smart money often pushes the price below the zone to trigger stop losses and absorb liquidity. The long tail of the tailed bar shows us that after the liquidity sweep, buyers stepped in aggressively, rejecting the lower price. The body of the tailed bar closes back above or inside the demand zone, which signals that the demand zone is being respected by smart money. The long tail tells us that all the selling pressure has been absorbed, and the market is now ready to move upward. This tailed bar acts as a confirmation to enter a buy trade after the liquidity sweep, as it shows that smart money has rejected lower prices. Now let's look at a tailed bar at a supply zone. In this case, smart money pushes the price above the supply zone, triggering stop losses and filling buy orders. After the liquidity sweep, the long tail shows that sellers quickly stepped in and rejected the higher prices. The body of the tailed bar closes below or inside the supply zone, signaling that smart money has rejected the higher price level and the market is likely to move downward. This is a clear sign to enter a sell trade after the liquidity sweep, as the long tail confirms that the price was rejected and the market is set to reverse. Alright, now that we've covered the three key components of our strategy, liquidity areas like supply and demand zones, liquidity sweeps and price action signals, let me quickly remind you of the steps to follow when trading this powerful scalping strategy. Stick to the 5-minute time frame for this strategy. You won't need to do any top-down analysis, just focus on the 5-minute chart. Since your trades won't last for hours, it's all about scalping and quick moves. Start by identifying the supply and demand zones where the market is likely to react. Make sure the zone is worth trading by checking the following criteria: the candle size of the move, the freshness of the zone, a breakout of previous structure, the risk-to-reward ratio. After spotting a quality zone, be patient and wait for a liquidity sweep at that zone. Once a pin bar, engulfing bar, or tailed bar forms after the liquidity sweep, that's your confirmation to enter the trade. Place your entry, set your stop loss, and define your target. Then, you can simply set and forget. Let the trade play out without constantly monitoring it. Alright, let me walk you through this real chart example to show you exactly how to trade this powerful scalping strategy. We've identified a clear demand on the chart. Now, before placing a trade, we need to qualify the zone to ensure it's worth trading. Let's break it down. Let's look at the candle size. The candles that form the zone are large, showing strong momentum and indicating institutional involvement. A good sign for a high probability trade. Now, let's check the freshness of the zone. This zone is fresh, meaning it hasn't been tested before. Since it's the first time the market revisits this zone, it has a higher chance of reacting strongly. Next, let's confirm the breakout of structure. Here we can see that the market broke through a previous resistance level, which signals that smart money is likely in control, adding more strength to the zone. Finally, let's evaluate the risk-to-reward ratio. The zone offers a favorable 3-to-1 risk-to-reward ratio, which is exactly what we want in a quality trade. Now that we've qualified the zone, let's see what happens when the market approaches it. Here's what we see: a liquidity sweep. Smart money drives the price below the demand zone, triggering retail traders' stop losses and filling limit orders. Then, the market closes back inside the zone, forming a pin bar pattern. The pin bar serves as our confirmation signal. Here's what to do. Place your entry at the close of the pin bar. Set your stop loss just below the pin bar wick. Target the next resistance level as your take profit. Once these are set, use the set and forget approach. Either the trade will hit your target or stop loss, with no need to constantly monitor. Take a look at what happened next. The market moved exactly as we expected, going in the targeted direction, confirming the strength of this strategy. Alright, observe this chart example. We have identified a supply zone. This zone is marked by a strong, clean downward move, with large red candles moving away from it. Although there is a small opposing candle, it failed to change the direction, and the market continued downward strongly. This sharp drop suggests significant selling activity by institutions, creating an imbalance and establishing a reliable supply zone. Before taking a trade, let's go through the checklist to confirm this supply zone's potential. First, observe the candles that form the move down. They are large, showing strong bearish momentum, indicating institutional involvement, a positive sign that this zone could hold when the market revisits it. This supply zone is fresh, it has not been tested since it formed. A fresh zone often responds more strongly because it hasn't absorbed any orders yet, making it ideal for a potential trade. As the price moved down from the supply zone, it broke through a previous demand zone. This is a strong indication that smart money is in control, adding more significance to this zone. Additionally, this setup offers a favorable 3-to-1 risk-to-reward ratio. This aligns perfectly with our goal, providing a limited risk and high reward potential. As the price returns to the supply zone, we monitor closely for a liquidity sweep. Here's what occurs. Smart money briefly pushes the price above the supply zone, sweeping liquidity by triggering retail traders' stop losses. The price then closes back below the zone, forming a bearish pin bar. This pin bar acts as our confirmation signal, indicating that the supply zone is still valid, and a market reversal is likely. Here's how to execute the trade. Place the entry at the close of the bearish pin bar, once the liquidity sweep is confirmed. Position the stop loss just above the pin bar's wick to control risk. Set the take profit target at the next support level. With everything in place, apply the set and forget approach. Allow the trade to progress without constant monitoring. The trade will either reach the target or hit the stop loss, making this strategy straightforward and stress-free. As shown here, by applying these rules, the market reached the target directly. Alright, let's go through another real chart example, this time using a tailed bar as our confirmation signal. I'll guide you through it step by step, keeping everything simple and engaging. We've identified a demand zone on the chart, but before jumping into the trade, let's make sure this zone is worth trading by qualifying it. Let's start with the candle size. The candles moving from the zone are large, signaling strong buying momentum, a clear sign that smart money is involved. Now, check the freshness of the zone. This zone is fresh and hasn't been tested before. That makes it more likely to trigger a strong reaction when the price revisits. Let's confirm the breakout of structure. The market has broken through a previous resistance level, signaling that institutions have already been involved in pushing the price up. Lastly, evaluate the risk-to-reward ratio. We have a 3-to-1 risk-to-reward ratio, which makes this zone favorable for a high-probability trade. Now that the zone is qualified, we'll wait for the market to approach the demand zone. As the price revisits the zone, we see a liquidity sweep. The market dips below the demand zone, triggering retail traders' stop losses and allowing smart money to collect liquidity. After the liquidity sweep, we get a tailed bar as our confirmation signal. Let's break it down. The long tail on the candle shows that the market was pushed below the demand zone, but buyers stepped in and rejected the lower prices. This tells us that smart money is absorbing all the selling pressure, ready to drive the market upward. The small body with the long tail signals that buyers have taken control, giving us the green light to enter the trade. With the tailed bar confirming the move, here's how you set up the trade. Place your entry at the close of the tailed bar. Set your stop loss just below the low of the tail. Aim for the next resistance level as your target. Once your trade is set, you can set and forget, letting the market play out. In this example, after the tailed bar confirms the liquidity sweep, the market moves upward, hitting the target as expected. One last thing, this is not a holy grail and I'm not selling dreams. It's a framework you can practice, test, and build skill with over time. This content is for educational purposes only and not financial advice. Trading involves risk. Always do your own research and consult a licensed professional if needed. Thanks for watching. If you found value in this video, make sure to like, subscribe to the channel, and turn on the notification bell so you don't miss future content. Stay disciplined, keep practicing, and I'll see you in the next one.